So can everyone see that?
Yes.
Great.
If you don't want, just before you start, if you don't want to be on screen, if you want to turn your cameras off, because we are recording. So
yeah, absolutely. If anybody's got, given the numbers, if anybody's got questions that are sitting there burning away whilst we go through it, please feel free to interrupt and ask the questions. There will be a short period at the end where you can ask any questions as well. But if you've got anything as you go along, feel free to ask. So before we start, happy National AI Day, which I think Karam will be particularly interested in, and it's also World Snake Day today, apparently. So thankfully, none of the latter in the room, but AI is everywhere these days.
It is.
It's good. So my name is Chris Dale. I'm a partner in our tax team at Azets in South Wales, where I head up our R&D team for the region, so central and west, covering Nottingham down to Truro. I qualified with one of the big four firms about 25 years ago, and I've been assisting companies with R&D tax claims for the past 20 or so years. And I think it's fair to say that in that time, it's probably the last couple of years that have seen the most significant changes in terms of the regimes, the beneficial rates, and also HMRC's interpretation of what qualifies and what doesn't. So we'll cover all of that during this presentation. And just to give you a quick, doesn't seem to want to move on. There we go. A quick look at the agenda. You'll be pleased to know that I tend to move through slides at a fairly rapid rate. So whilst it looks hugely daunting there on the agenda, the slides will be relatively quick. So that gives you a bit of an indication there of the kind of changes that have happened. That's just in the last 2 years. We'll go through those in a bit more detail a bit later on, but that just gives you an indication of things that have been happening through recent government changes and also policy changes. And it's a kind of a sit up and listen moment, I guess, for those that have done R&D claims before who are unaware of the changes, because there have been huge changes, and some of which, dare I say, are designed to catch companies out somewhat. So we'll come on to a couple of those pitfalls shortly. It's probably worth just starting from the beginning before we go into all of those changes, and just going back to what does actually qualify for R&D tax relief. And this is probably the one area that hasn't changed much over recent years. So there's still 2 key qualifying criteria that an R&D project has to meet. The first of those is that there's some kind of scientific or technological advancement sought in what the project's trying to achieve. And HMRC look at that through the eyes of a competent professional in that field. So if you're doing a software development project, then they would look at whether a competent software developer would view what you're doing as a significant advancement, either in the overall knowledge within that field or in the application of that knowledge within that field. And science excludes things like economics, most humanities, the arts. It focuses purely on what was used to be termed science and technology, if you like. And then the second key criteria, probably the most important one, because overcoming scientific or technological uncertainty probably gives you your advancement. So the key criteria there is that there's some kind of uncertainty there involved in what you're looking to do. And again, that's looking at it from a competent professional's viewpoint. And it's saying, well, should a competent professional in that field be able to determine how we get from A to B in this project, or could they get that information from publicly available sources? So If the answer to both of those is no, and the competent professionals left there scratching their head as to how they're going to develop a new product, make something faster, make something more durable, make something more economically friendly, environmentally friendly, then that's probably a starting point. If that competent professional who's been in the industry for a few years has got maybe a qualification, relevant qualification, then if they can't work out how to do it, and they can't be relatively certain that it's going to work, and they can't get that information from publicly available records, then that's just a starting point for a project qualifying for R&D tax relief. I'll start with the positives of those bullet points. And so it doesn't matter if your project is unsuccessful, you can still claim for the costs that you've incurred up until you've decided to can the project. In fact, having an unsuccessful project often helps the story to demonstrate to HMRC that there was scientific or technological uncertainty there, because you've been unable to overcome that uncertainty and you've had to shelve the project. It also doesn't matter necessarily if somebody else has created something similar or exactly the same, as long as how they've done that is not in the public domain, and as long as that competent professional would have been unable to therefore determine using their own knowledge or what would be expected of a competent professional's knowledge and any publicly available information, if they couldn't use that to get to the same answer, then you as a company, and I should have made that point at the start, this is a company tax relief, you as a company can still continue to claim R&D tax relief whilst you've still got that uncertainty yourselves. On the not so positive side of things, not all new product development will qualify. So you could have a situation where a chair with 4 legs works perfectly well, is perfectly stable, durable, takes weight as you want it to, etc. And somebody decides to come along and add a 5th leg. Well, it's a new product, but does it have that technological or scientific uncertainty involved? So, Tom, I think you had a question.
Yeah, thanks, Chris. In terms of if it's been sort of tried and tested elsewhere internationally, but maybe not within a UK domestic setting, would that sort of in terms of the uncertainty question, would that be a level of uncertainty that would sort of qualify you for that sort of thing?
It's any kind of, your knowledge could come from anywhere, so that you'd be looking worldwide at that publicly available knowledge. But if it's not available, so how they did it in wherever, Germany or Spain or wherever else they're doing that work, if how they did it is not publicly available, then you'd be okay. And ultimately, if you look at it from a commercial perspective, if the answer is already out there, you're not necessarily going to spend that much time in trying to find the answer yourself, because somebody else has already come up with it. So there are degrees as to how things apply to your situation. So if you can distinguish what you're doing as being slightly distinct from what was done overseas, and therefore the knowledge in respect of that particular aspect that you're distinguishing is still unknown, then you could claim for certainly aspects of that project.
Thanks.
Okay, great. We'll come on to a couple of case studies in a second, which hopefully highlight in a bit more detail what qualifies and what doesn't. Worth pointing out, though, that some areas will be quite grey as to whether the specific knowledge was already out there. And there have been plenty of cases that have gone to tribunal where companies have argued one way and HMRC the other. Quite a lot have gone in favour of the company, it should be said. So once you've worked out whether your project qualifies, what type of costs can you then claim for? And these would be revenue type costs. So rather than machinery, etc., which would be capital in nature and you'd get capital allowances from a tax side of things, these would be revenue type costs. So staff costs, gross salary, employers' NI, employers' pension, and travel costs potentially. A bit of a quirk with travel costs in that you the employee has to incur the cost first and then claim it back. So via an expense claim, for example, if the company settles those costs directly, so they pay for an air ticket for somebody to go over and test something in wherever, America, then that wouldn't be claimable. So something companies should potentially look at when they're starting off on those R&D journeys. If there are going to be considerable travel costs, then if it's suitable for their business needs, then ask the employee to pay first and then reimburse them, because you can then include those costs in the R&D claim. Consumables that are not sold on to anybody or transferred to a third party. So if you've built a prototype and you're testing it, you're not selling that on, then you can claim for that prototype. You can claim for consumables that are used up or transformed during the R&D, and that includes an apportionment of heat, light, and power, etc. Any subcontractor costs potentially, and we'll come on to subcontractor costs in a bit more detail shortly. Externally provided workers, so labour agency type costs, where you get people to come in and work alongside you under your direction and control. Any potential software licenses, so if you've got CAD licenses, for example, and you're using that to design products for your R&D, then those can be included. And new from accounting period started after 1st of April 23 are cloud computing and data license costs. Those are the main categories. If you're in sort of pharmaceutical trials, then payments to clinical trial volunteers also can also be claimed, and also mathematics costs can be claimed. Okay, so quick couple of case studies to look at whether things qualify or not. So we've got an NHS equipment and PPE management company, and they're looking to reuse hospital ward curtains. So it's lovely thin blue curtains that you put around the bed. They were obviously used up quite quickly because of infections, etc., or trying to reduce infections, and they used to just be thrown away into landfill. So companies have looked to reprocess those to recycle them, and this company has bought a machine in that melts down the curtains, cools them into a solid block, so that's ready for onward processing and recycling into something else. This is not something that the company has done before in this example, and the company has made no adaptations to the machine, and the machine basically says on the tin that it will melt down materials of this kind and then cool them back into a solid block. So can the company claim R&D tax credits in this instance? The answer is probably always going to be potentially, because you always need to look at companies on an individual basis, on this individual scenarios and the particular details of what a company has done. And in this case, you'd be looking at what was known. So you'd go back to your two key qualifying criteria, your advancement and your uncertainty. Now, it may be that loads of companies are already doing this, and there are loads of machines on the market that say that they do this, in which case you probably haven't got an advancement in this situation, and you wouldn't qualify for R&D. Equally, the machines themselves have been tested before by the manufacturer of those machines to see whether they would process materials of this kind, and they tested it and found that they could. So there's no uncertainty there either. However, it may be that when the company looks to do this, they come across issues with it. So maybe it doesn't fully form into a solid block, and therefore the machine doesn't do what it says on the tin, and the company has to look with its own engineers as to how you can adapt the machine to try and get it to do exactly what you're trying to get it to do in this instance. So there may be pockets of R&D in some projects, but in this case, it's using existing knowledge, existing machinery in a routine way, and therefore unlikely to qualify. Case study 2. So looking at the same company, in this case study and the next one, So it's now looking to reuse slightly different material, so polystyrene, and it gets in from all the packages that the hospital gets in, and it's looking to do a similar process, but at the end of it, it's then looking to make buckets, cutlery, and other products from the recycled material. And apologies for any scientists on the call if any terminology is incorrect, but yeah, the high level overview here. So the company uses the same machine, which again says that it's able to deal with polystyrene and melt it down and solidify it by cooling it. Again, this is not something the company has done before, but it's not made any adaptations to the machine. But in aiming to try to develop saleable plastic products, the company and its engineers are uncertain as to how they could go about developing and manufacturing such products from the recycled polystyrene. And in this instance, so again, the question is, can the company claim R&D tax relief or R&D tax credits? In this instance, there are sort of two stages to this process. The first stage is that routine melting down and cooling and solidifying the recycled product. The second then is trying to manufacture new products from that recycled material. And it's likely to be that second part where there's more chance of there being qualifying R&D. So again, you go back to your two qualifying questions. Is there a scientific or technological advancement here? And it may be in this instance that the use of recycled polystyrene has not been tested in any significant detail. Now, I fully accept that it has, but if we accept for a minute we're back at the start, before it had been, then there may well have been not much in terms of technical reports available publicly, which explained what would happen to polystyrene in this recycled form. And would it be flexible enough? Would it withhold weather? Would it be durable? Would it withstand weight, etc.? Be pushed on it. The particular pressures for cutlery. Would it withstand those forces? And there are plenty of examples of companies at the moment trying to develop these sort of things in paper, for example, particularly on the cutlery side of things, where they're looking at all those issues, and there isn't that bank of scientific evidence to back up whether that material in that form could do everything that they wanted it to do. So in that instance, very likely that there's technological uncertainty there because maybe it hasn't been done before and it's not publicly available as to how they go about doing it. And you've got that clear advancement that you're able to make new products from recycled waste. And then case study 3, same company has now developed this line. It's making all of these great new products, but now it's looked at its production line and it thinks, well, actually, if I move this around a bit, so logistical movements, and I move machine A to parts to where C is at the moment and C to B and move it all around, then we think we can make it A, more efficient in terms of the time taken to get through the process, and also B, more energy efficient. So the company does what it was proposing to do, and great, it's found out that actually it has made those savings and those efficiencies. So can the company claim R&D tax credits in this instance? So again, the first answer is it depends on exactly what was done, but purely looking at logistics, even though you may have an innovative idea which has resulted in those efficiencies and those gains, that just looking at logistics on its own doesn't fall within that sort of scientific or technological banner. And therefore, if it was just a case of moving these machines around and all of the machines were expected to work as they did before, and it was found that there were no issues, then no, probably not qualifying R&D there. However, if there was uncertainty that if you moved machine A to C, that it would throughput the material in the same way, then there's potentially an angle there for an element of qualifying R&D in that kind of work. So So appreciate those are 3 fairly quick case studies, and everywhere is going to be a relatively niche area. So are there any questions on that? No? Great. So if we revisit...
Sorry, there's one.
Okay, sorry, yeah.
Sorry, Chris. I didn't
That's
want to
okay.
interrupt you in your flow.
No, that's
you
right.
might be coming on to this. It was just more around the costs and the potential savings. Maybe you're going to cover this, but like what companies might actually benefit in terms of financial savings.
Yes, absolutely.
Yeah,
and
you're covering that, are you?
Yeah, yes. And so
Fab.
apologies. I did have it as slide 1, but then I moved it around a bit this morning. But
Nice.
yes,
Awesome. Thank you.
We'll be coming on to that in a bit. And apologies, I can only see 4 names on my screen. So if somebody else has got their hand up, I might not spot it. So yeah, looking back then at the timeline of recent changes and things to look out for, particularly pitfalls in terms of new forms that HMRC have brought in. So for accounting period start after 1st of April 23, so a lot of companies have got December year ends, so that would be their December 24 year end onwards. There is now a requirement to pre-notify HMRC within 6 months of the year end that they intend to make an R&D claim. What used to happen before that rule came in is that you would have 2 years from the end of your accounting period to submit the claim. And therefore, if you had a December 24 year end, and this was your first time you were going to make a claim, then you could have made a claim up into any time up until December 26. And what often happened was that companies would get new advisors as they grew, and those new advisors would be more switched on to the possibility of making an R&D tax claim. And then they say, great, let's do the 2 years, 24 and 25, and we'll get them done by December 26. Now, if those companies haven't made that pre-notification claim within 6 months of the year end, so by June 25, then they can't make a claim in respect of that December 24 period. There is if a company's made a claim within the previous 3 years, so for December year end, you roll forward 6 months to 30th of June, and then you roll back 3 years. So if a company's made a claim from the 1st of July 22 to the 30th of June 25 for that December year end, then that's fine as long as that claim wasn't made as part of an amended corporation tax return after the 1st of April 23. So a bit of a nuance, and not something that I expect you to take away from this call, but something to bear in mind if you're talking to companies who maybe make it, or you've got your own companies who may be making R&D tax relief claims, then there is this need to look at that pre-notification requirement within 6 months of the year end. The form itself is relatively straightforward, so it's almost worth doing a protective claim, protective pre-notification if companies are unsure. There's the widening of the scope that also happened 1st of April 23 to include some of the things we've discussed, so data license, cloud computing and mathematics. The rates changed from the 1st of April 23. We'll come on to that in a bit, but essentially there were before 1st of April 2023, there were 2 main R&D schemes, one more beneficial one for SMEs, so for companies, and you'd include broadly connected parties, but for companies with less than 500 employees and a turnover of either less than or no more than 100 million euros, or balance sheet gross assets of no more than 86 million euros. So there's one there for the SME companies, more beneficial rates, and then there was one for larger companies and any SMEs that had been funded to do their R&D. So before 1st of April 23, 2 schemes, and that changed from 1st of April 23 because the rates reduced. They brought in what was known as an R&D intensive scheme for loss-making SMEs. Because the rates had diminished considerably for normal SMEs, the government didn't want to punish those R&D companies that were R&D intensive, if you like, and therefore they gave them an additional benefit. So There is now 3 schemes: your SME, your large company, which is the RDEC scheme, and an R&D intensive scheme for loss-making SMEs. And then for the 1st of April 24, so accounting period started after 1st of April 24, that's now moved to having one merged scheme, so the SME and the RDEC scheme merged, and largely under the old large company RDEC scheme rules. But they've also kept this R&D intensive scheme for loss-making SMEs, and that's where the most beneficial rate lies, as we'll come on to in a second. Some of the other changes that have happened recently: there's a requirement now to complete a new HMRC form before submitting your claim. So your claim is submitted as part of your corporation tax return. You have to submit this digital form to HMRC, and this is not the pre-notification form, this is a separate submission form before your corporation tax return goes in with the R&D in it. A couple of the minor admin points there. And then, as we'll see from accounting period start after 1st of April 24, there are changes to the types of cost that can be claimed. And we'll look at that in a bit more detail shortly. So, as I said, there's now largely one merged scheme and the R&D intensive scheme. So the main merged scheme carries with it a maximum cash benefit of 16.2% of your qualifying expenditure. So if you add up all of your qualifying expenditure under these categories, that will give you a total. So let's say all of that comes to £100,000. Then you apply the effective beneficial rate of which is a maximum of 16.2%. It'll be somewhere between 15 and 16.2%. So in the best case scenario there, you'd get a beneficial cash repayment of 16,200. And alongside that, you've got the R&D intensive scheme, and that is for companies who have got qualifying expenditure that is at least 30% now of their total tax-related expenditure. So when I say tax-related, that is all your costs in your P&L that relate to the trade, subject to any tax adjustments to those numbers. So where that fraction or where that percentage is at least 30%, then you get to claim the improved cash benefit, which has got a maximum benefit of 26.97%. So near 14% difference there. Nope, can't do maths. Near 11% difference there in rates. Okay. Some of the other changes that came with the merge scheme relates to the contracted out R&D. So you may be a company, you're doing an R&D project, but you can't do a certain element of the project, and therefore you subcontract that work out to another company to do the work. Now, under the old RDEC large company scheme, you couldn't claim for those before, but you can going forward, or you can potentially going forward, and it depends on who is driving that R&D as to who can claim for it. So if you've got a customer, company A, who comes to you, company B, and says, we want a new valve to work on our submarine that can withstand pressure at 5 kilometers below what the current valve can withstand. We expect you to do some R&D for that. However, we don't know what that R&D is going to involve because you're the specialist. In that instance, you as company B are likely to be able to claim R&D tax relief on the costs that you incur for that. If it's the case that company A comes to you and they are also a valve specialist, but they don't have a particular machine that can do X, Y, and Z, and they say, right, we want you to develop this valve in this way, and we think it will do X, Y, and Z when it's added onto the submarine, but we haven't got the machine, therefore we need you to machine it, then potentially that's more likely to be company A's qualifying R&D, and you as company B wouldn't be able to claim in that instance. So contracts will be key going forward, where you've got one company who's kind of directing the wider project, but your company may be involved in doing that R&D. And similarly, the other way around, if you're the company that's doing the main project and somebody else is doing a bit of the R&D. Okay, a couple of other quick points. So before, you used to be able to claim for costs worldwide. So if the subcontractor was based in Australia, then that was fine. You could still claim for qualifying costs in respect to the R&D done over there. Same with any agency-style workers, but they have removed that ability now, subject to a couple of exemptions. And those exemptions are largely where the R&D has to be performed in overseas because of, say, conditions. So, for example, if you're testing drill rigs and you're testing them in environments that are not in existence in the UK, then you have to test them overseas, then you'd still be able to claim for those costs. There used to be, as anybody who's done R&D claims before and had grant funding will know, there used to be particular restrictions associated with subsidised expenditure. That's no longer the case under the new rules. So the bit that everybody's interested in is what are the maximum beneficial rates now. So first column there, counting period started 1st of April 2022. That's the old regime where you had SME and RDEC only. And as you can see, the beneficial rate was a chunky 33.35% then. So if you had £100,000 of qualifying expenditure, you get £33,350 back in cash, potentially. Those rates came down on the 1st of April 2023, so the effective maximum benefit now for SMEs would be 22.79%, unless you're R&D intensive, which came in from the 1st of April 23, and then you can get that maximum of 26.97%. Conversely, the large company rates are going up, so good news for those claiming under the large company scheme and now under the merged company scheme. The maximum beneficial rates gone from 10.53 to 16.2%, as you can see in the last column for the merged RDEC scheme. Quick run through current HMRC landscape. Many of you may have heard it's a little bit like the old PPI environment at times, or has been over the past couple of years, where you've had certain rogue agents calling companies and saying, well, your competitors A, B, and C are all claiming, they're claiming an average of X, therefore we will apply those averages against your P&L costs and put in an R&D claim, and we'll get the money back for you. And up until 2 or 3 years ago, the inquiry rate from HMRC was only around 1%. So of all claims going in, so 99% of claims which go in under a self-assessment system would have just been processed and paid, and therefore there was a lot of fraud and error within the regime. A couple of years ago, it was estimated at greater than 1 billion just in the R&D scheme itself, and bearing in mind that the R&D scheme itself is only worth 7 billion. That's a huge chunk that was estimated to be fraud and error. So there's been a significant increase in the number of HMRC inquiries, now at 17%, not just 1%. So nearly 1 in 5 are now inquired into, which has resulted in huge delays, which was obviously not good for genuine claimants. But it has meant that there's been a lot of tightening up of claims, such that there's far more information goes into claims now to explain why projects qualify, whereas before there was a lot of nonsense going in. HMRC are taking the fraud aspect of it extremely seriously, and there have been several agents who are facing criminal investigations into their practices. All of this also led to further guidance from HMRC because they felt, rightly so, that certain companies were just saying, great, agents, you go ahead and do whatever you want, and weren't getting involved in the process at all, even though ultimately the risk lay with the company because they were the ones signing it off. They'd left the agents to it, and therefore there's a lot more guidance published by HMRC on what should be done to make a claim. We mentioned the pre-notification additional information forms, and on top of that, there's also additional documentation required now. So whilst there's still not the need for, say, detailed timesheets to record people's time that they do in R&D, then HMRC do expect to see a lot more contemporaneous documentation, emails, project plans, drawings, that sort of thing. So what's coming up next for R&D? No significant changes noted in the recent spring statement. As part of Rachel Reeves's 5-year roadmap that she put in place when she started, she did say that there wouldn't be significant changes to the R&D, and we'll see later on the patent box, tax regimes, which gives companies a certain amount of certainty. Of course, governments do change their minds, and therefore never say never. With the increase in employer NI contributions, that's actually going to be a positive for R&D claims because you can include employers' NI in your costs, which will therefore increase the cost. One silver lining for companies. There's now a dedicated disclosure for professional bodies to report, so that comes back to that forward and error where people knew what was going on but didn't really have anywhere that they could go and disclose it. They're looking at putting advanced assurances in so companies can go to HMRC and say, I'm about to do this, will this qualify? And then their next 3 claims will probably not be given as much scrutiny. It may work. It didn't particularly work last time it was brought out because HMRC asked more questions at that stage than they would have done in inquiry anyway. So it was not beneficial to go down that route. And there is an R&D expert advisory panel, believe it or not, coming into force, but they will be largely dictating policy rather than looking at individual cases. So other innovation-based tax credits, there are plenty of other things, so not just R&D. There's good reliefs available for film and TV production, video games, theatres and orchestras, museums and galleries. And each of those has got its own separate regime, similar to R&D, where companies can get cash back. There's also relatively linked land remediation relief, where if you are renovating land and there's contaminants in there that obviously you haven't put in, then you can get tax relief on that. And similarly, where you've got capital cost that's linked to your R&D. So for example, you may be building a laboratory. Normally structures and buildings would get you 3% writing down allowance for tax purposes. If it's linked to the R&D, so for example, you're building an R&D lab, then you'd get 100% deduction in that year 1 for that. But it's the top one we're going to concentrate on very quickly. That's patent box, and this has grown a lot in its popularity. It came in 2013, but because tax rates were relatively low in the UK, so 19% for corporates, companies weren't as interested as they are in it now, because with an effective tax rate of 10%, it's obviously a big gap to the 25% standard corporation tax rate that companies face at the moment. So similar to R&D, it's an incentive to drive innovation in the UK. And this applies to any income streams and the profit generated thereon that have come from patented technology. And that could be a patented product or a patented process. And it can incorporate wider items. So the examples often given is you patent an exhaust of a car, but you sell the car as one item for one price. Then you can bring the sale of the whole car into those patent box calculations. So it can be particularly beneficial form of tax relief. it does give you an additional tax deduction. So even though it's the headline is that it's a 10% tax rate, the way it works is that it gives you an additional tax deduction, which therefore reduces your tax liability, which would suggest potentially that it's only beneficial for companies that are paying corporation tax. That's not quite true. So you would need your patented product to be returning a profit for Patent Box to be of benefit to you. However, if your overall company is making a loss because you've got non-patented products that are making a loss, for example, then Patent Box can still be beneficial in respect of those profit-making patented income streams. Lots of words. So the Patent Box regime, who can claim? So again, it's a corporate tax relief. So for companies or corporate partners of partnerships. And the two key criteria that have to be met for Patent Box is that you have to own a qualifying intellectual property right. So largely we're looking at patents. So either you have to own the patent or you have to have an exclusive license to use that patent, and that's exclusive to at least one territory. So for example, you could have company A owns a patent, company B has an exclusive license to sell that patented product in the UK. So nobody else can sell it, only that company B. So that would qualify from an ownership perspective. And those patents have to be awarded by the UK's Patent Office, the European Patent Office, or certain EU countries, of which, likes of France, are not a qualifying country. And then second key criteria is that there's the qualifying development test has been met. So the company has had some significant involvement in either developing that patented technology in the first place or in extending its capabilities after it's originally been developed. Quick example of what that can do from a tax perspective. So this company's got taxable profit of £1 million, 60% of it related to its patented technology income stream. As with any tax calculation, there are lots of things going on in the background that they've input for, deliberately at times, you feel, but there are bits going on in the calculation in the background which will give adjustments to these numbers. So in this instance, those adjustments total 50k. Those straightforward numbers there would give you a patent additional tax deduction. So that's a deduction in your taxable profit of 330k, which reduces your corporation tax payable from 250k to 167k. So a third saving in that example. One thing to be very wary of if you're ever going to be in a group situation, and that is looking at that ownership and development criteria together. So you have to look at those from a company specific perspective, not a group perspective. Before the rules changed in 2016, another group company could do the development work if they wanted to. However, in 2016, there was an additional part of the calculation which looks at an R&D fraction, which says how much of the R&D have you done yourself, company, or contracted to a third party. But that's good R&D. Bad R&D is where you're subcontracting to another group company, for example. So you could have a scenario where company A owns the patent, so it's got the qualifying IP right, but company B in the same group did all of the development work. That's what we've got here in scenario A. And as you can see, your R&D fraction, how much R&D have you done as company A? So company A is the Patent Box company. It owns the patent. How much R&D have you done? Nothing. And therefore your R&D fraction is nothing and your Patent Box benefit will be nothing. Whereas if you restructure that slightly so that you've actually got some qualifying R&D cost for the development of that technology in your patent claiming company, so company A, then as you'll see under scenario B, you can change that so you get the full Patent Box deduction, and in that instance it changes your corporation tax due from 250k to 90k. So again, not expecting you to remember any of the detail, but just to be very aware that if you have got companies that are looking to patent something, that there is this corporation tax benefit available, And if you're in a group scenario, then it's best to get in early in terms of looking at that structure to make sure that you're not going to miss out in future years, because you've got the patent's life is up to 20 years, and therefore you've potentially got 20 years of benefit of lower corporation tax charges at stake here. And therefore it could be quite considerable. One other thing to note is that you can start accruing the benefit from as soon as you apply for a patent, but you have to tick a box on your corporation tax return if you want to do that. Great, I think that covers everything I had to say. Is there any questions? Or have you all nodded off after lunch?
There
No,
was a
Claire.
question about whether you could share the slides.
Yeah, absolutely. Yep.
Okay. Thank you.
Absolutely as clear as mud then, isn't it, Chris?
Yeah, I think the key thing there is, unless you've done it before and you're happy with the changes, to look for advice. It doesn't have to be big, expensive exercises. If the company's happy themselves doing the majority of the work, then it can just be a pointer as to what documents you need to complete and when, and what the potential benefit is. So
Seems to be there is potential there that people probably aren't aware of or don't think it's relevant to them, but there seems to be a lot of things in there.
Yeah, absolutely. And it's when it first came out, people thought that it was sort of aligned only to people in white coats testing in laboratories. Well, it's not that. The starting point is really head scratching from the competent professionals as to how they're going to do something, and that could be something quite small, but take a very long time because it's complex, and that's the starting point as to when you should be thinking, well, there's potentially qualifying R&D tax credits here, because even though the rates have come down, it's still, if you're an R&D intensive company, it's still almost a third
It's
of
a
your
lot, yeah,
qualifying expenditure, and you can get that on top of any grant income as well for the project.
Yeah, that was going to be my question about how many people actually know about this, because it seems like such a good thing to do, and yeah,
it's a lot more publicized than it used to be, but it's like anything, isn't it? If you're not aware of it, you don't see the snippets that turn up everywhere.
Is there sort of resources, Chris, that are easily, like, I suppose obviously what you've given us today has been really helpful, but is there sort of like a go-to resource that you'd recommend for people to look at this if they wanted to investigate more?
Yeah, absolutely. I can add some of the links. There's actually a very good guidance manual that HMRC have come up with, which kind of walks you through it. But I think where companies are likely to need advice is where, if they are sitting on in that grey area of does this qualify or not, is it seen as an appreciable improvement? Because it's all very well to have ideal world scenarios in the guidance as to what qualifies and what doesn't, and there are plenty of examples in there as to what qualifies and what doesn't. But in real world scenarios, they tend to be a bit more blurred.
Yeah, everybody's got a slightly different perspective, and I mean, I know we're even in sort of accessing innovation grants and things like that from Welsh Government. There's a grey area as to, is it innovation, isn't it?
Yes. Yep, absolutely. Patent box is a lot easier.
Yes.
Because the that greyness has been taken out as part of the patent application stage. Now it does still involve looking at the technology as part of that application stage, but once it's been granted, then it's easy.
I mean, what's come over for me, really, the key question is you just need to ask the question, are we eligible? Don't sort of rule yourself out.
Yeah, absolutely. I mean, there are industries that HMRC don't like to see claims coming from. It's like care homes and restaurants and things, because of those rogue claims that were put in. But that's not to say that you couldn't have R&D in those areas. If care homes are working with GPs to work out how to improve knowledge about certain diseases, or how to try and cure certain diseases, then they will be doing qualifying R&D. Similarly with restaurants, if they're looking to use new materials or use new ways of cooking that haven't been done before, and the evidence isn't there, then there will be qualifying R&D there. But you know, people adding a bit of raspberry to their lemon tart and trying to claim for that sort of thing, or automating their paper records in a care home scenario, that they don't qualify.
Okay. Anybody else got any questions?
No, it's been really helpful. I think it's super interesting.
Thank you very much for your time, Chris. It's sort of I think
No
it's given everybody a lot to think about. We'll share the recording out to the rest of the team, so there might be some other information coming back, and maybe some further questions as well.
Yeah, absolutely. If you've got any further questions, feel free to ask.
That's lovely. Thank you ever so much for your time, Chris.
Great.
Thank
Cheers
you.
all.
Thanks,
Thank you.
everybody.
Bye.
Bye.